All right, so let's run through the legal disclosure here. Rocket Dollar and its affiliates do not provide tax, legal, or accounting advice. This material has been prepared for informational purposes only and is not intended to provide and should not be relied on for tax, legal, or accounting advice. You should consult your own tax, legal, and accounting advisors before engaging in any transaction. There we go. The key part here is every investor or everybody should have their own team around personal finance because it is, well, deeply personal. So let's go ahead and move on. Here's the agenda for today. We're going to run through the difference between a traditional and a Roth IRA. We'll cover some of the common self-directed Roth questions. We'll get into the 5-year withdrawal rule, which is an important one to understand. And then a huge opportunity, Roth conversions. We'll talk through those. And we've got a couple of slides here discussing some advanced strategies. One of them is called the Backdoor Roth. This is something that high income earners can take advantage of, and I'll walk you through how to do that. And then the last one is on the Mega Roth strategy, which is a technique inside the Solo K, which is the other product that Rocket Dollar offers, which ties into a Roth IRA. So there's an interesting opportunity there. And then we'll take some questions if there's any from the floor or any from the audience. So this is me here. I'm an angel investor. I'm the COO here at Rocket Dollar. Also, I've got a background in mostly enterprise software, but studied finance at school. And then kind of a personal story. I opened my first Roth IRA in 1998, which is about a year after it was created. I'd walked into a bank and spoke with an investment advisor at the bank, and I said, how do I save money, or what's the best way to retire well off? And he introduced me to the concept of a Roth IRA. And then years later, while helping my wife start a business, we found the Solo 401k, and now fast forward 10 years, and here we are running a company that does both. So kind of a fun fact. Moving on. Okay, let's jump right into it. So what's the difference between a traditional IRA and a Roth IRA? And so with a Roth, all your contributions grow tax-free. So you can put, there's a $6,000 limit on how much you can contribute into an IRA, whether it's Roth or traditional. But those Roth contributions have a separate tax and special tax classification. So you put that money in now, it grows tax-free over the course of your lifetime. And then should you wait until retirement age to withdraw it or to take what they call distributions, you can take those distributions tax-free. So that can be a huge boon to your retirement funding, and is generally a very important part of retirement planning and retirement strategies. And so remember, you're funding this with post-tax dollars. So this is after you get your paycheck, after the government takes FICA and Social Security and Medicare and any state taxes. With money that you have left over, you can make those contributions to a Roth IRA. And then a traditional IRA works a little differently. You put money into a traditional IRA, and you get a tax deduction today or this year when you go to file your individual tax return. And so it lowers your taxable income, saves you a little bit of money. And then when you go to take a distribution later in life, you pay taxes on those distributions. The distributions are called required minimum distributions, and there's a table which dictates how much you need to take out each year. So really the difference here is one of them saves you taxes now, and the other one saves you taxes in the long run. And then whether or not you should use one or the other, there's a number of ways to think through that. We'll cover some of them here. But we offer at Rocket Dollar here the self-directed IRAs, whether both traditional and Roth, or all flavors of the IRA actually, but self-directed, which is also sometimes called a checkbook IRA, which is what we specialize in at Rocket Dollar, makes it easy for you to invest in alternatives such as real estate, startups, and precious metals. I mentioned precious metals because even just last week, hedge fund titan Ray Dalio is talking about gold and talking about opportunities in investing in gold. So precious metals and gold may be making a comeback. I don't know if I'd call it a comeback yet, but it's interesting to see even some of the real thought leaders in finance are talking about gold again. And then, of course, most of our clients really love real estate and startups. So really, if you go get a Roth IRA just about anywhere else, any of the big companies, typically you've got to buy stocks, bonds, and mutual funds, or that's what you invest in inside the account. And with ours, we make it easier for you to invest in anything. Real estate, startups, precious metals, and again, you could even do stocks and bonds. We can show you how to do that if that's what you want to do. Again, the Roth IRA was established by, it was the Taxpayer Relief Act of 1997, Public Law 105-34. And it was actually named, trivia question here, it was named for its chief legislative sponsor, Senator William Roth from Delaware. Cool. So that's sort of the history on it. Okay, we'll move on. What are the contribution limits for 2019? So 2019 contribution limits have gone up to $6,000. They were $5,500 last year. And then if you're over age 50, you can make something called a catch-up contribution for another $1,000, which gives you a total of $7,000 a year. And if you start thinking about the math over time of you putting $6,000 a year away into an account that you can withdraw from in retirement age with no taxes, the compounding is pretty powerful. This is in general, this is a pretty easy way for most people to become a millionaire. What about my spouse? Well, it does not matter if your spouse contributes. You can, or you can both contribute. The full amount for which you qualify, this is their individual retirement account. So you want to zero in on that keyword individual. So in a household, you and your spouse can both have Roth IRAs. And what are the qualifications for a Roth IRA contribution in 2019? So you'll want to look at your household situation. You may want to consult a tax advisor or a CPA or an enrolled agent, but you're going to have to determine whether you're going to file single, or if you're married, are you going to file jointly or file separately? And then you want to take a look at your adjusted gross income. And then depending on what threshold your adjusted gross income falls in, that determines how much you can contribute. We'll look at some of the numbers on the next slide. We've tried to simplify this here a little bit. So there is an income phase-out range, which for a single individual is above $137,000. So if you're making above that, you cannot just make a regular Roth IRA contribution. There is a technique, though, for still getting money into a Roth IRA. I'll talk about that later. But for most people, of course, their income is probably below that. And depending on, again, what range your income falls in, that determines how much you can contribute. Single individuals, your range is from $122,000 to $137,000. Now, in that range, you can still make some contribution. And depending on where you fall in that range, that determines how much you can contribute. And again, if you're above $137,000, you will not be able to contribute. And if you're below $122,000, you contribute all $6,000. And now if you're married and filing joint, which is the most common way in which Americans file tax returns, your range is $193,000 to $203,000. So if you're above 203, you're not eligible to make those contributions. If you're in that range, you can make a pro rata or a portion of the $6,000 contribution. And if you're below $193,000, you can make the full contribution. So depending on your situation, that determines how much you can contribute. And again, talk to your tax advisor, but most of this information is out there on the web too, and it's pretty easy to sort through. So what's the 5-year withdrawal rule? You might have heard about this. This is an important feature of the Roth. So the 5-year rule allows you to withdraw your investment earnings or even the funds that you have converted to Roth from another tax status without penalty if you keep the earnings in an account for at least 5 years after a contribution. So to make this simple, let's say I make a contribution this year, it's 2019. As long as I hold those funds in my Roth IRA for 5 years, and it starts with January 1st of this year, even if I make the contribution in December, then I can withdraw those funds after 5 years without a penalty. And that's an important part of this, an important feature of the Roth IRA. It basically gives you access to the funds in the event that you need them later on. So some additional information on the 5-year rule. What should I keep in mind? I mentioned this already. The 5-year rule begins on the January 1st of the calendar year where you make your contributions. It's not when you open the account, it's when you make your contributions. And that's to any Roth. And then again, after that, you can withdraw your earnings in the form of a distribution tax-free, as long as you've held on for 5 years. You can always withdraw your contributions at any time. So if I put $5,000 or $6,000 in this year, I can take that $6,000 out at any time. It's the earnings that need to be held there for 5 years. And if I withdraw them early, I could incur a tax penalty. So this is an important piece too. You really want to do some planning here and make sure that you're not going to need the money that you're contributing to the IRA. So what I typically recommend at the household budget level is you plan to make your investment, or rather your retirement and your investment contributions to your different retirement accounts or investment accounts, depending on your strategy, and that you do your spending and your planning after you've already planned for your investments and your retirement accounts. Otherwise, you might get hit with these penalties if you have to start taking the money out early. Okay, the last piece. Can I do this for my Roth dollars that are in my solo 401k? And I get the presentations on the IRA, but there are some interesting places where the IRA and the solo 401k interact with one another. So yeah, you can do the same thing with a solo 401k. So if you're putting money into the Roth bucket inside your solo 401k, and you need to take the money out, you can do that as long as you've held on for 5 years. So what you do need to make sure is that your 401k plan allows for something called an in-service distribution. And you can do that by looking at your plan documents. If you're a RocketDollar customer, you can rest easy because all of our plans allow for in-service distributions. But if your provider is somebody else, you may want to take a look at your plan document and just do a search in a PDF for in-service distribution and see whether or not your plan allows for these. And now remember, the 5-year rule does not carry over to a new Roth IRA. So if you open a new Roth, rollovers will be subject to the same waiting period. Okay. That's a good thing to know, especially if you also have both products with us. Last piece, does this apply to conversions? And so let me talk through first what a conversion is. So conversion is, let's say somebody was putting money into a traditional IRA for 10 years before the Roth IRA even existed. The legislation allows for you to convert your traditional IRA funds or even a pre-tax solo 401k contributions to a Roth. And so when you do that, that's called a conversion. So you're taking pre-tax dollars and now making them Roth dollars, which means the government wants its taxes, so you're going to have to pay your taxes. And the way you do that is you call your IRA provider, you fill out some forms, and then the IRA provider moves funds from the traditional to the Roth, and then we'll send in a 1099 for you to report the taxable income, and then start the clock ticking on the 5-year rule for the Roth IRA. Which is what we just covered on the previous slide. Great. So this is the specifics here, and we'll send the slides out afterwards. Okay. A couple of other things about the conversion. This is looking at this most recent tax bill, the Tax Cuts and Jobs Act. Tax rates are still like at a relatively historic low, especially if you're a small business owner, which I have a slide on here at the end. So this is a really great strategy. Many successful retirement investors have a strategy that includes piling up as many Roth dollars as possible. So if that's your strategy, this is actually something worth doing. All right, so how do you do it or how could we do this at RocketDollar if you have accounts with us? This is a nice graphic depiction of how it plays out. So you put money into a traditional IRA account, and then you convert the account to a Roth IRA, and then you'll pay taxes on what was in the traditional IRA. It will show up on your tax return in the year in which you did the conversion. So if you did it this year, it would show up this year. And then the rest of the funds would go into your new Roth IRA. You could do this with RocketDollar, and these would be self-directed traditional IRAs and a self-directed Roth IRA. Okay, and now a couple of interesting techniques. So this is one of my favorites. This is the Backdoor Roth IRA. So what is a Backdoor Roth IRA? Well, it's a technique for high income earners or people who are outside that range where they're eligible to make an IRA contribution to put $6,000 into a Roth IRA. And the technique is pretty simple. You open and you fully fund a traditional IRA. And again, the limit this year is $6,000. And this is actually what the IRS calls a non-deductible IRA contribution. Again, remember, your income's too high to make a deductible contribution, so you make a non-deductible contribution. And then the best way to do this, or the smoothest way to do it, is you put it into this traditional IRA, let it sit in cash, and wait a day. And then the following day, you convert that traditional IRA to a Roth IRA. So you do a conversion. You don't have to wait a day. I recommend you wait a day, though. Or you can do it at any time once the contribution has been made. You might forget about it, and if you do forget about it, you can come back and do the conversion later. But a good technique here and a clean way to do this is to wait a day and then make your conversion. And then you may owe taxes on any gains if you do wait, which is why I always recommend that people do these right away. You'll sometimes, and there's a form that you have to fill out with this. It's this at the bottom of the slide, IRS Form 8606 for non-deductible IRA contributions. You'll have to do a little bit of work on that form. And if you have, or if you invested the money in the traditional IRA before you did a conversion and it made some gains, you might owe tax on those gains. That's why I tell you to throw it in cash, leave it there for a day, and then make your conversion. It'll keep this process as easy as possible. A couple other things you'll need to know here. If you already have traditional IRAs or SEPs or simple, which is another type of IRA, with assets in it or with investments in them, you'll need to convert those to a Roth before you can start the non-deductible contributions. This is called the pro rata rule. So this is a really important thing to pay attention to. And most people that screw up a backdoor Roth screw it up right here because they've got some other account out there that they forgot about. And the IRS will, the IRS very well may recognize and see that. So something else to note, you could also transfer those accounts to a solo 401k from Rocket Dollar. I had to do this actually. So we had an old traditional IRA, and before I started doing the backdoor, I had to take a traditional IRA and find a place to put it. So I actually rolled it over into my Rocket Dollar Solo 401k. So the Rocket Dollar Solo 401k plans allow for rollovers and transfers from any qualified plan or an IRA. So that's one interesting technique here. It's another place where the 401k comes in to bolster the IRA. And so again, the way to talk through that, we had an IRA balance that needed to get zeroed out before we were eligible to do the backdoor. So I rolled over the IRA to a self-directed solo 401k from Rocket Dollar. Now my IRA, traditional IRA balance was zero. I can now go do the backdoor Roth IRA. That's how those things play out and work together. And then also, what's cool about this is both you and your spouse can do this. So if you're both high income earners, this is a nice way to get $12,000 a year into Roth IRAs. And again, you get all the benefits of having a Roth IRA. So that account will continue to grow over the course of your lifetime. And then in retirement age, you can pull it out and take tax-free distributions. You can also, if you have a family or you're doing estate planning, you can pass on Roth IRAs to your children, and your children will pay no taxes. This is actually a technique called the stretch IRA, which is actually there's some legislation or there's some debate happening about whether or not the Congress wants us to continue to be able to do this. However, as of today, it's something that you still can do. If you want more information on that, feel free to email me. So how much can I contribute to my Roth Solo 401k? This is another interesting way in which the accounts work together. You can contribute both traditional and Roth dollars in the same plan and in the same year. So one way in which this might work is you make pre-tax contributions to Rocket Dollar self-directed 401k, or if you don't necessarily want the tax deduction and you like the idea or you believe in a strategy of having as many Roth dollars as possible, you could make your contributions to a Roth 401k. And you'd be able to put $19,000, assuming you have that much income, into your Rocket Dollar self-directed Roth Solo 401k. Okay, the Mega Roth. There's another strategy. So this is, again, a solo 401k plus an IRA. So the Mega Roth is a strategy to put as many Roth dollars as possible into your self-directed solo 401k. I sometimes will see people refer to this online or in different forums as a loophole. And I actually disagree. This is not a loophole. This is a feature. So the IRS in Notice 2014-54 discusses this feature of 401ks. It is a technique that the IRS has signed off on or communicated to the public with that they have no problem with it. I call that a feature of these 401k plans. In the Rocket Dollar self-directed solo 401k is fully set up to allow for this type of strategy. And so here's how it works. The self-directed solo 401k account holder, so that would be like me with my side business or any one of our account holders that has a self-directed solo 401k, would open another account for their solo 401k for after-tax contributions. You would make those after-tax contributions, and then you convert those to a Roth just like you would in the backdoor IRA that we just talked about. This is an important point here. And this is where people mistake or make a mistake with the mega Roth strategy, is that they don't seem to understand that there's several different types of buckets of money inside a 401k. There are 3 types of money in a 401k, or they have different tax statuses or different tax consequences. There's pre-tax, which is where you would get a tax deduction and you would take that on your individual tax return. There's Roth dollars, which is you put the money in now. You don't get a tax deduction now, but you can take it out tax-free later. And then there's after-tax. And so after-tax dollars is no different than me going and opening like a brokerage account at Schwab with money I have left over at the end of the year. After-tax accounts or after-tax dollars pay taxes on any income gains or any distributions from your investments. They're typically taxed at short-term capital gains or long-term capital gains, depending on how long you held on to them. So again, those are 3 different buckets with 3 different sets of tax consequences. And where people get confused is they mistake the Roth and the after-tax dollars as being the same thing. And I understand why that happens, because if you think about it, you contribute to a Roth with after-tax dollars, but Roth has separate tax consequences, whereas this after-tax bucket does not. And actually, that like in the public law or in the law that makes this thing possible, there's something called the 415 C1A limit. So that's just the maximum contribution that you can make to a 401k. Pretty simple. That's the $56,000 number in 2019, which is up from 2018. And if you're over age 50, you get a $6,000 catch-up contribution, which would take you to $62,000. So if you wanted to, you could put $62,000 if you're above age 50 and you have enough self-employed income into an after-tax 401k bucket and then immediately convert it to a Roth. And so if you think about this, this is now a powerful technique for getting $62,000 into a Roth. It could be a Roth 401k, or you could even send it out to your IRA and send it out to a Roth IRA. So that's extraordinarily powerful. So to streamline that, again, you could do that right into a Roth IRA. So now with Rocket Dollar, of course, our IRAs allow you to do self-directed investments. So we've now just shown you a path to put $62,000 if you're above age 50, or $56,000 if you're in your 30s, or anybody under age 50, and then turn all of those $62,000 into investments in alternative assets. And so if you're a real estate investor or a startup investor or somebody with some expertise in any of these alternatives, this is a really, really wildly powerful strategy. You can see here on the slide, I refer to this as the secret weapon of personal financial planning. And this is partly why. Any converted amount and any gains need to be reported to the IRS with a 1099. And there's a specific distribution code that has to go on that 1099. So we do those for our clients if you have an account with us. If you're thinking about doing this, give us a call. We'll walk you through how to do it. And then hopefully you get the benefit of that over the long haul. So imagine doing this now for 3, 4, 5 years, even 10 years. If you're a business owner, you could potentially have well over $600,000 in Roth dollars in just contributions. And that's if you make no money with your investments. So this is, again, this is pretty wildly powerful. And then for those of you that are business owners and have an SCorp, so real quick, I'll define what an SCorp is. So an SCorp is not a entity type, it's a tax election. So let's say you have a limited liability company or another type of entity structure. You can elect to be taxed as an SCorp. And people do this because it saves them on self-employment tax. Well, the Tax Cuts and Jobs Act this year, this is the tax bill passed by the administration under President Trump, created a qualified business income deduction of up to 20%. And that's applied to many S-Corps. LLCs that are filing as S-Corps often qualify. And for people that are self-employed, it basically gives you, if you're self-employed, a way to compete with big companies who have a corporate tax rate of only 20% now. So this basically created the same tax rate for all businesses, whether you're a big conglomerate or a big corporation, or just a one-person shop hanging up a shingle working out of a WeWork office. And so you can, as an S-Corp, you can sponsor your own 401k plan with Rocket Dollar. It would be a Rocket Dollar self-directed solo 401k. And then if you have your own Roth IRA, now we can put all these things together and come up with a really cool strategy. So the SCorp owner makes your employee contribution into your solo 401k. And you could skip the employer contribution because you're still going to get a tax deduction via the qualified business income. That's just going to show up on your individual tax return instead of on the corporate return. Then you can go and maximize the after-tax contribution to the solo K, convert it to your Roth IRA via the Mega Roth strategy. And now we've done the same thing for a business owner. So we've now shown that business owner how to put, depending on your age, anywhere from $56,000 to $62,000 into a retirement account. That's a retirement account that allows you to invest in alternatives. And at the same time, you're still getting the qualified business income deduction that came out of the new Tax Cuts and Jobs Act. So this is a fun thing for me to talk about. I like being able to put all these different pieces together and see how they all play out and how they help you save money and build a better future. So that is the SCorp strategy with the Solo K and a Roth IRA. Again, if you want more information on that, feel free to contact me. I'll tell you a little bit more about RocketDollar. So our focus here is on building a product and a service that allows people to very easily manage these self-directed retirement accounts. We do that with automated bank account creation. You can e-sign all your documents. There's no more printing, signing, faxing, and scanning, and all that goes out the window. You don't have to do any of that anymore. We will create a limited liability company for your IRA. If you like the IRA LLC, if you're using a 401k, we'll create a trust for you. We manage all the documentation. We push it out to you through a dashboard. This is the modern way to manage a self-directed account. And again, we'll take some questions. We'll hop over to the tool here, see if anybody's got a question. We've got some attendees still on the line. If you guys have got questions, feel free to submit them. Let's see here. Okay, for those of you still on the line, I'll wait a minute or two for you to submit some questions if you have any. Okay, looks like no questions have come in. So feel free to reach out if you have any that you'd like to talk about later, if you want to talk through any of these strategies. We want to give a shout out here to the Austinpreneur Studio at Capital Factory for letting us use this space. They've been wonderful partners and investors. We love the folks here. And again, Chris Palmisano, actually, let's see, looks like we've got a question coming in. So, or a chat here, let me pull this up. Okay, Marco, just created a solo and the trust was set up, but the automated bank account was not automatically created. Yeah, so look, Marco, there is some information that has to make its way over to the bank. And so most of that we send over. There are some unique situations where we do have to talk to somebody ahead of time. Most of the time, though, this stuff is actually done in a pretty automated fashion. And in some cases, it depends on actually when you signed up. I will make a note of this, and I'll have the support team give you a call to make sure everything is working fine. You got it, Marco. No problem. Okay, that's it, folks. Signing off. Thank you, and have a great day.